the day before Thanksgiving type crowd today.
Right.
What's up, man? Good to see you.
Okay.
All right.
Awesome.
Christopher, is there any like interesting, embarrassing story you reckon they might do to introduce you?
Yeah. Hey, I'll throw some softball for you.
Sure. That's awesome, man.
So I was gone. I just came back this way.
Iron Man.
Yeah, he said he just
Not messing around.
No, yeah, I got to get myself in shape.
Well, guys, it's 11:32. Hopefully we get as many people as we did for Morning Ascent. We have a couple more trickling in here. Good to see some familiar faces from this morning. Very excited to hear from Christopher today, as I hope all of you are. So yeah, really, I'm just going to turn the time over to you, Christopher, and we'll go from there. Okay, let's give him a big round of applause for a small group. There we go.
I'm impressed that you're all even here, to be honest with you. The day before Thanksgiving is pretty awesome that you're here. So thank you. Let's have some fun together. This is going to be, I'm going to do a lot of talking, but this should be an interaction, a discussion, because you're going to have a lot of questions. I promise you, you're going to learn things that you do not know, that you thought you knew about credit and how it applies to you personally, but also to your clients. Because this is super important when it comes to lending, but it's also super important just in life and everything that you're dealing with every kind of loan that you all have. We're going to teach you some tricks and some things you need to be aware of that I know you're not going to know, that will help you in your life. Okay? So as we go through this, we'll get through as much as we can in an hour. If we get through all of it, great. If not, no big deal. But make sure you stop and you ask any questions you have about anything at all. Okay? Because we're going to talk about credit, how it works, what it means, what implications there are, how it can better benefit you. Because credit is, if you look at this slide, this is kind of how we view credit today. It's kind of gotten crazy and out of hand. How important people view credit with everything in their life, right? It controls and dictates tons and tons of stuff when it comes to your finances. So, again, I'm going to ask you some questions. So what is a credit score? Tell me first what is a credit score? Those of you that know. Tell me what you think it is or what you believe it to be. Come on. I don't want to have to pick on anybody. What's a credit score? Yes, Carrie.
A ranking of your responsibility with your finances.
Okay, a ranking of your responsibility. Yeah, that's great. That's a good summary. Any other thoughts on what a credit score is? Yeah.
I look at it more like it's your ability to make consistent payments.
Okay, your ability to make consistent payments. I like that. Yes.
It tells the world what you do with your money.
Tells the world what you do with your money. I love that.
And it's not about how much money you make, it's about what you do with the money you have.
Awesome. Yes, Jeff.
I'd say it's a ranking of how well you use credit.
Okay, a ranking of how you use credit. I like that. Those are all awesome. Yes, Chris.
Ready to move on. I was going to say like a debt tolerance scale.
Okay.
Even.
A debt tolerance scale. That's good. Those are all awesome answers, and I think you're all right. A credit score. Well, let's just go and tell you what it is. Let's tell you what a credit score is first, and then why it's so important. Okay. So a credit score it's a mathematical formula. It's a number. You get a credit score through a mathematical computation that was developed by the Fair Isaac Corporation back in the 1960s. The reason being is before the 1960s, if you wanted to get credit, what did you have to do to get credit? If you wanted to buy a house, get a car loan, whatever, what did you have to do? You have to interview. You got to know your local banker, right? Your neighborhood banker. You'd have to go down to the bank. He better know you, and I say he because he probably was a he. He better know your family. You better have a bunch of money there. And if you didn't know those things, guess what? You're not going to get a loan, right? And as the world evolved and people started moving around and you didn't know your local banker, there had to be a better way to determine whether it was worth giving someone a loan. So Fair Isaac came up with the model. It's a 3-digit number. Okay, a credit score is a 3-digit number that gives you a ranking and does all the things you talk about to evaluate the risk of lending you money. That's why I've got risk over here. Credit is a 4-letter word. It's not a 5-letter word, it's a 4-letter word. Risk, R-I-S-K. Everything about credit's about your risk. How risky is it to lend you money, and how likely are you to pay it back? Bottom line. How risky is it to lend you money, and how likely are you to pay it back, particularly on time? Okay? Here's the score range of credit, 300 to 850. We rarely see anything down in 300, and we rarely see anything above 850. We'll talk about what that means, but just so you know, that's kind of that's the window of what a credit score is. And I love this last thing. Credit isn't a right to be expected. It's a privilege to be earned and protected. It's something we have to work on to live in this world. In the United States, you have to understand how credit works. Otherwise, it's going to bite you in the fanny, and we're going to talk about it. Any questions about this so far? Just remember risk. Remember the word risk, because it has to do with your credit, but also with lending, right? Everything we do as a mortgage bank is about risk, okay? Now here's kind of score talk. Here's what these, the 300 to 850, kind of on a academic scale of what it means. So what's an A plus, right? Anything above an 800, we'd call that an A plus credit, okay? And you kind of see what those credit scores are. You may know what your credit scores are, okay? We do loans, no problem. You get the best rates on credit that's above this mark here. You still get pretty good loans above this mark here, actually above this mark. We do loans clear down to over here on FHA, right, down to 550. But typically you're going to want to see your scores at least above, you have to have at least a 620 score to get a conventional loan. So really we want to get people in this range here. This is going to get you the best interest rates, going to get you the best terms, the best options, have the highest score possible. Makes sense, yeah.
So I've heard a lot of people say that over 740 it doesn't make that big of a difference with loans.
It doesn't. Yeah, once you get, as I mentioned, anything kind of in this, whoops, let's go back. Anything in this range here is excellent.
And that's you cap out with the benefit.
Yeah, you can't get, your rate doesn't get any better if your score is a 760 or an 800.
Okay, gotcha.
But it's important to have as high a score as possible because your score is a living and breathing thing. It's constantly doing this, just like your breath. It's constantly moving up and down. It doesn't stay stagnant, okay? And if you're breathing, you want to be breathing in this range. You don't want to be breathing in this range because if you get in this range, it affects your interest rate, right? If you find yourself wanting to get something when you're on a down breath, it's going to impact your rate. It's a great question. Yeah?
Well, what would be an example of, like, I know you're not perfect, but somebody who's in the D range versus somebody in the A range? How big of a difference?
Massive, and I have a slide we're going to show you. Great question. It's a huge difference. Tons difference. So great question. Okay, this is a kind of a graph that shows the likelihood that someone will pay back on any kind of a loan if I don't know anything about them other than their score. So if I don't know if you're a male or a female, black, white, Jewish, Christian, Muslim, whether you make $1 million or $1, whether you live in New York City or Salt Lake City, if I don't know anything about you, all I see is a score. This tells me the likelihood that you're going to pay something back on time and not be late. If I have an 800 score, there's only a 1% chance I'm going to be late on something. And you can see how it increases, and it really jumps up once I get to 650. Once I get down to 550 and below 500, you can see the likelihood that someone is going to be late on an account. Now, why is this important? Why do I as a bank or any creditor care about this? Why does this matter to me? If I'm going to lend you $300,000, why is it important that you're going to pay something back on time?
Because you get late fees on the high risk.
Yeah, well, it's kind of a rhetorical question, isn't it? I mean, if I'm going to lend you money, go ahead. Yeah.
Well, I was just gonna. I mean, besides the obvious, I mean, they're also going to be spending money pursuing that money.
Correct.
Yeah.
The money's not free. So the money that we or anyone else, the credit union or a bank lends you, that's money that they need to be working. It's got to be earning interest. They make interest when you make the payments. If you're not paying on that debt, they are losing money, the creditor, right? So again, remember, R-I-S-K, risk, 4-letter word. How risky is it to lend you money? How risky is it that you're not going to pay something back? If you're a super low risk, you're basically a zero risk down here that you're not going to pay something on time. This is not just paying back, this is just paying on time. Every month, month in, month out, that you're not going to be late. I'm going to lend you money all day long because I know your history shows me that you're going to do it. If you're over here, I'm going to lend you money, but it's going to be at a totally different interest rate because the risk factor just went up by 50%, right? Huge. Now this data is collected by FICO scores. FICO is the Fair Isaac Corporation. FICO's been around since the 1960s, right? And there's credit reports pretty much on every human being that's ever lived in the United States for the last 50 years. there's tens of billions of data points on history, which is why this graph is so important and spot on, because it's all this is statistics. This is just data from the credit bureaus that say we can go look at every piece of data forever since credit's been invented to know how likely someone's going to pay back simply because of their score. Yeah.
If you're gonna address this later, just tell me.
Yeah.
But like I've had clients in the past that are like actually really wealthy, but they pay cash for everything. So and we've ran into issues before with like because they basically have a non-existent
Terrible score.
Yeah, terrible score.
Yeah.
Yeah. So are you discussing that later?
We will. Yeah, we'll talk about why. We're going to talk about how your score, what impacts your score exactly. There's 5 components that impact your score. How to get a higher score, why it might be lower. We see that a lot. I mean, I'm all for paying for cash. That's great. We don't need to be going into debt. If you can live your life that way, fantastic. Unfortunately, the world we live in requires some credit. Right? You got to be able to prove how risky you are to lend on stuff, even if you're going to pay cash. And we see that all the time. Super wealthy people with scores way down here because they don't quite understand how credit works, right? And we address it a lot, particularly when someone gets a mortgage loan. We'll get someone that comes in and think they don't have any debt, they've never been late on anything, but their scores are low. And we'll talk about why that's the case, because there is a little bit of a game with credit you have to understand. Any other questions about this? Does this make sense? Why your score is so critical and important? Why it's such a big deal, and why it's the first thing we look at when we take an application, is we pull someone's credit report and look at their credit, look at their score, because that tells us right away what kind of rate are they going to get, what kind of terms they're going to get, how much of a house can they afford. Okay? All right. Now getting back to your quick question, Jason, about what's the impact if my credit is good or bad. Okay, and this is just an average. What's the damage of lower credit scores? We're looking at an average $300,000 house. And these aren't what rates are. These are rates from probably a few years ago, okay? But this is just a good example. If your score at the time was above a 720, you'd get a 4.5% interest rate. This is your payment. This is what you'd pay on this loan over 30 years. Look at what you'd pay over 30 years if your your credit was below a 680. Not a huge difference, below a 680. 200 grand more over the life of the loan. $555 more per month you're gonna pay for the exact same house. Exact same house. 2 identical houses, 3 different borrowers, all bought tract ivory homes, no difference, right? They're paying between $100,000 to $200,000 difference for the same house over the life of the loan, simply because of their credit score, no other reason. And you can multiply this out with their car loan, with their credit card payments, with their student loan payments, any of the debts they have. It's not going to be as dramatic as this, but everything gets ratcheted up. If you're a renter, you pay way more in rent when they pull your credit than if you have good credit, or if you have bad credit versus good credit. You may not be able to get your utilities turned on. They may require a deposit if your credit scores are bad. There's all kinds of ramifications based on your credit score. Make sense? I'm going to show you a quick video here that's going to help kind of tee up the rest of what we're going to talk about today.
We all know that credit scores are important. This 3-digit manifestation of your financial trustworthiness impacts your ability to get a loan, the insurance premiums you pay, and more. As a result, having a good credit score rather than a bad one can save you $648 a year on your credit card, $1,392 a year on an auto loan, and $2,340 a year on your mortgage. You might therefore want to know how to go about improving your credit score. There are a number of steps you can take to improve your credit score. For starters, check your credit reports for errors. 1 in 5 credit reports contains a mistake, and this could be undeservedly holding your score down. You should also have at least 1 open credit card or loan, and ensure that it's in good standing. This will result in positive information flowing into your credit reports every month. But don't submit mass credit card applications, as this signals risky desperation and will drag down your credit score. If you aren't having any luck getting a credit card, place a refundable security deposit on a secured credit card in order to start the credit building process. No matter what type of credit card you get, make sure not to max it out. And don't close unused accounts unless they are costing you money, because that would reduce the length of your credit history. Finally, if you don't trust yourself to be responsible with credit, Take precautions by automatically withdrawing your monthly payment from a bank account or even locking your card away so you don't use it. Keep in mind that it takes at least 12 to 18 months to actually see your credit improve, but the timeline depends on how much information, positive or negative, is already on your existing credit reports. For more information about improving your credit score or to join the conversation on the topic, visit WalletHub's Credit Score Improvement page.
Okay, any questions about that? So we're going to talk about a bunch of those things as we continue here. We're going to talk about a lot of those specific points about what you can do to improve, how to get your scores up, how do credit cards impact your score, what to do with credit cards, because they have a huge impact on your overall credit rating. People don't understand that. It's super important to understand how it works. Okay, here are the credit factors. We talked about kind of the scoring model that determines your score. As I mentioned, there's 5 areas that make up your scores. Just like you take a class, and the first day of class, the professor gives you the syllabus and says, here are the things that are going to determine your grade. These essays, these exams, these assignments, these tests, that's going to determine the overall grade in your class. This is exactly how credit works. Here are the 5 parts of the class, so to speak, that determine your grade when it comes to credit. Obviously, the higher the score, the lower the interest rate on anything you do. The biggest thing is your payment history. We'll go through all these individually. Payment history, the amount you owe, particularly on credit cards, the length of credit you have, any new credit you open, and then the type of a credit accounts that you have. Those are the 5 areas, and the percentage of those areas, the weighted average of what impacts your score in those particular areas. And we're going to go now and spend time in each one of these 5 areas, because this is where the nuts and bolts, the nitty-gritty, where the rubber meets the road when it comes to your credit. Okay? So number 1, your payment history. This counts for 35% of your score, a third of everything you do, and it's pretty much self-explanatory. How do you pay your bills? Do you pay them back on time or not? Period. When I get some debt, when I get a loan, am I paying my things every month on time? Yes or no? It's black and white. Super simple. Do I pay on time or do I not pay on time? Does that make sense? A third of your score simply has to do with being responsible, paying your debts on time. Now when we say on time, how many of you have a mortgage or a car loan or a credit card, assuming all of you have that, and you get your monthly statement and it says my payment's due by the 1st, right? But they all give you a little bit of a grace period, right? Typically 1 to 2 weeks grace period. And then after the grace period expires, what happens? There's a late fee, okay? So I have until from the 1st until the 15th to make my payment. If I paid on the 16th, there's a late fee. Now, is that impacting my credit? If I paid on the 16th on a mortgage or a car loan, I paid 2 weeks after it was due, I'm incurring a late fee, is that impacting my credit? I was late, it's a late fee, but is it impacting my credit?
I don't think so.
Okay, why isn't it impacting my credit?
Well, because I think it has to like go further into like a delinquency or something where.
Excellent.
Yeah.
Okay. What is credit view delinquency period? What is a delinquency time frame? How late does something have to be?
Isn't it 30 days?
30 days. So if my payment was due November 1st, and I paid between the 1st of November and the 15th, no problem, no late fee, I pay my bill just like it says. If I pay on the 16th, between the 16th and the 31st, I'm going to have a late fee, usually a 5% late fee. I'm going to pay a little bit more. No problem. The credit bureaus don't know. It's not considered late. It's on time. I'm just paying a late fee. But if I pay on December 1st for an account that was due November 1st, ding, 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 late. And they're going to report that as a 30-day late on my credit report. Credit report is in 30-day increments. They report if you're 30 days late, 60, 90, 120. They look at things in a 30-day cycle, okay? Do not be 30 days or more late on your credit. If you are, one simple little credit 30-day late can impact your score 50 points. So you saw that score, if I'm at a 760, if it impacted me to 710, that could be a full 0.5% difference in interest rate, could be tens of thousands of dollars. And this could be it doesn't matter what kind of account it is. We've seen people who had a Target card, had a $5 balance on it, and they were late. Because they forgot. That $5 card cost them 50 points, made them not qualify. Some stupid little account that they didn't pay attention to, okay? It doesn't matter how big the debt is, whether it's $5 or $500,000. If you're late, you're late. and it dings your credit severely. Particularly the younger you are and the less mature you are with your credit, it impacts you more. If someone is 50, 60 years old with tons of credit, lots of history, and they are late one time, it may impact them maybe 15 to 20 points. 25-year-old that only has a few accounts, it's going to impact them 50 plus points. Devastating for one silly little account. This is all about responsibility, bottom line, okay? People have collection accounts. You often deal with clients that have collection accounts, and they get, they're told, pay off your collection account to get qualified. Do not tell your clients that. Anytime you pay off a collection account, your scores go down in the short term. We can deal with collection accounts when it comes to mortgages. If someone tells you, I have a collection account, I probably can't qualify, that's not true, okay? Their scores could still be fine if the collection account was old and it's been sitting there for a while. There's reasons why that's the case. So if you hear that, make sure they're not going and paying stuff off, because if they do, it'll affect their score immediately and it'll drop and it can make them so they don't qualify, okay? Being past due on any account, again, can cost you more than 50 points. Doesn't matter the type of account. Derogatory. Derogatory means I've been late on something, okay? I was 30 days, 60 days, 90 days late. And by the way, if you're 60 days late on something, now it may impact your score 100 points. If you're 90 days late something, it can impact your score 150 points. The longer you go and are late, the more impact it has on your score. So someone that's just not paying their stuff, or they're always late every month they're 30 days late, well, it's devastating. Their scores are the 400s and they can't do anything, okay? Derogatory accounts, let's say someone had some bad history a few years ago, had a bad spell, got late, and then started paying things on time and have kind of gotten back on their feet and are paying things great. Your credit history profile is active and current for 10 years, meaning anything you've done credit-wise, we can see for a 10-year period. So an account you opened 9 years ago and closed 8 years ago, you may think it's not impacting your score, but it's still on your credit report. We can still see it, and it could still be impacting your score slightly. It's a 10-year window that we look at. After 10 years, things tend to automatically fall off. People used to think they would fall off after 7 years. No, it's a 10-year window, and if it's a derogatory account, sometimes those things don't fall off at all. They just stick on there forever, and you have to manually request that they be removed. So again, heightening the importance of just don't be late if you can avoid it, because it's just so hard to deal with it if you are. Yeah?
From a bank perspective, just from logic, can you kind of explain if you have basically, if I understand, you have an open collection account that's 2 years older, more, and you're saying if you pay that off, that negatively affects someone's account more than if that collection account is still open?
Yep. So it's not intuitive. That's not what I said. So it's not an intuitive statement. Here's the reason why. It's credit looks at things, they look in the most recent history first. That's what's most important. What's been going on in your life in the last 2 years? It's the same reason with financing. We ask your clients, I need a 2-year employment history. I need a 2-year housing history. I need to know what's going on in your life for the last 2 years, because the last 2 years are tell me what's most likely to happen in the next coming years. Does that make sense? Your most recent 2 years tells me more about you than what happened 20 years ago. And so we look at your last 2 years of credit history profile, and the credit bureaus look at your last 24 months of activity more so than activity that occurred longer than that ago. So if you had a collection account that was from 2 years ago and it's been now more than 2 years, that now fell out of that 2-year window that we're really looking at. But if I pay it off, guess what? It's now in my 2-year window. And they're saying, oh, here's this collection account that, yeah, you paid it off, but it's a collection account and now it's a recent activity and it dings your score.
Gotcha.
Okay? And we understand that as a bank. Fannie, Freddie understand that as national government lenders. And so if you have collection accounts on there, oftentimes FHA, we don't have to do anything about it. You can just say that we don't have to worry about it. Just leave it alone. It's a small amount. We don't have to worry. We don't have to worry. Just leave it alone, like it's not even there. And we move on. Sometimes with conventional loans, we have to pay it off. It has to be paid in full, but we'll usually do that at closing, not before, so it impacts their score. But that 2-year window is why we don't want to mess with it. But a lot of loan officers or agents will hear their clients have this collection account and think we need to pay it off because it's going to look bad if they had it. And they go and do it, and they go get pre-qualified, and their score just dropped 50 points because they had this dumb collection account and they paid off. Has anyone had a collection account before? I have. I mean, this is one of the most frustrating things because it can happen and you have no idea. Like in my case, I went to a doctor and then moved, and they never tracked me down. And I had a $25 copay, and they never told me about it, and I didn't find out until 3 years later. They put a collection account on there for this $25 copay, and I said, well, you never tracked me down. Well, we tried, right? So I was able to get it removed, but it was a pain, right? That kind of stuff is out of your control, which is why it's important to look at your credit every year, which we'll talk about, because there's going to be little rinky-dinky things like that happen that were no fault of your own. Like the video said, there's a ton of data on your credit that's just flat out wrong that you've got to make sure you're monitoring. That's why it's so important just to make sure you're watching it, okay? Good questions. All right, this next part is I would say the most important part of what we're going to talk about today, because it's very different than what most people understand how credit works, and it has to do with your credit cards. Okay, so 35% has to do with being late or paying on time. Another third of your score has to do with what you owe, and particularly with managing your debt, which direct straight to credit cards, 100% to credit cards. Your credit cards, or lack thereof, affect 30% of your credit score. Huge percentage of your score, which people say, well, time out, I don't want a credit card. I don't want to go into debt. My mom and dad told me I should never had it. Yeah, that's true, I totally get it. But again, credit's a little bit of a game, and to have an optimal credit score, you gotta have some credit cards. Doesn't mean you need to have debt on them, but it means you have to have some open accounts, because it accounts for 30% of your score. Why do you think that is? Why do you think that accounts for such a big part of your score, credit cards, or what we call revolving accounts? They revolve, yeah.
Just to show your responsibility with debt that you have.
Okay.
And history.
Bingo, yes. To show your responsibility. How do you manage your debt? What's the difference between a mortgage loan and a credit card? How are they different?
One's closed-ended, the other one's revolving.
Okay, one's closed-ended. So on a mortgage, I borrow X number of dollars. I have to pay Y number of dollars every month. Doesn't change for 30 years. Either I pay it or I don't. Pretty simple. Credit card, I am issued credit, $5,000, and the bank says, use it as you want. You can use it every month and pay it off. You can use a little bit and pay it off. Just use it as you want. It's open-ended, right? How do I manage that leeway? That's a leash you've been giving. How do I manage the leash, okay, that I've been given? And so that's why it accounts for such a big percentage, because it really goes to the heart of how can you manage your income, your debt, the responsibilities you have. Yeah?
So does it affect you based on the limits or the balance? That's
Both. Okay, we'll look at both. It affects you both, okay? Let's look at it. Bottom line is you need to have some credit cards to have an optimal score. Ideally 2 to 4 credit cards, 3 to 5 in that range to have an optimal score, the highest score possible. New debt that you put on your credit card can temporarily decrease your score in the short term. But the thing that you want to remember is your limit isn't so much important, it's what you owe in relationship to your limit. Does that make sense? So whether your limit on your card is $500 or $50,000, that's not what's so important. It's how much you owe percentage-wise in relationship to the limit. So if I have a credit card, just for easy number's sake, it's a $1,000 limit. I have a credit card that's a $1,000 limit, okay? And every month I spend $500 on that credit card, and so every month I get my statement and it says you owe $500. I owe 50%, right, of the credit card limit. Okay, does that make sense? Simple math. When it comes to credit, anytime you owe more than 50% of the limit on your card, it impacts your score slightly. Okay? Why do you think that is? Why is owing 50% or more on a card considered somewhat of a credit risk? Okay, we'll come back to it in a minute. Think about that. The second I owe 70% or more on my credit cards, usually for at least 3 months, my scores could be affected by 20, 30, 40 points. The second I owe like 80% or more, it could drastically affect my credit score. So let's say I had that same $1,000 credit card, and every single month I used all $1,000, or I maintained a $1,000 balance that I was just trying to pay off. So every month the credit bureau saw I owed $1,000 on this credit card, and it was the only one I had. Why is that such a high risk?
Increasing debt.
Increase in debt.
And not being able to manage your money.
Okay, if I'm paying it on time, I'm never late. So I got the $1,000. I'm paying that baby every month on time. I'm never late. I'm paying it on time. Why is it still a risk?
Are you paying it off, or are you paying minimum payments?
Probably minimum payments. but I'm paying it every month. I'm paying what they're asking me to pay.
Because you're incurring more debt.
So I'm not using it anymore now.
Mhm.
I've maxed my limit, I
Yeah.
can't use it, but I'm paying it off every month. Let's go here and then there.
Well, you talked about it's a leash that you're managing, right? And you're
Yeah.
basically just you're pushing the limits to what you're allowed to spend, I guess. I mean,
Okay, I'm pushing the limit on what I can
you're still
spend.
you're still okay on your payments, but at least your credit limits are almost maxed out.
Okay, yes. We call that being maxed out. Anytime you owe more than 70, 80%, we say you're maxed out on your card. Yeah.
In their mind, you're just, month in, month out, making ends meet. That's all you're able to do.
That could definitely be the case. But remember, what's the four-letter word, right? Risk. Life happens. People get sick. People have accidents. People lose their job. People get divorced. People move. People have deaths in their family. They have children. They have to put on new tires of their car. Life happens, right? If I'm maxed out on a card and life happens to me, what am I going to pay first in my life? Am I going to pay a credit card, or am I going to go buy milk? Am I going to pay a credit card, or am I going to pay my mortgage? Am I going to pay my credit card, or am I going to get my kids shoes? Right? So the algorithm and the formula from, again, 50 years of credit show that when you're maxed out on a card, it is way more likely that you're going to be late on that card and not pay, because life will happen, and when life happens, you are not going to pay your cards. Your credit cards are the last thing that you're going to pay. You're going to pay everything else first, right? And so now it's a much higher risk for that credit card company to give you money, and you become an overall higher credit risk to lend, period, because of that. Where if someone has a credit card and they have that $1,000 limit, but they always keep it at like $100, and life happens, they can use their credit card to live on a little bit, to pay for the shoes, to pay for the milk, to pay for the gas, until they can get back on their feet, right? Does that make sense?
Mm-hmm.
So having those credit card limits is so critical. Below 50% is so critical. You really want to maintain them below 30% if you can here, particularly in the 3 to 6 months someone's going to buy a house or get some kind of account. You want to keep your balances below 30% of the limit to maximize your score. Getting back to your question about a lot of wealthy people. We see wealthy people that have 10 to 20 credit cards, limits of $50,000 to $100,000, okay? And they're maxed out on all of them. And they may make $2 to $3 million a year, have $500,000 in the bank, have plenty of money to pay their stuff, but their credit score is sitting at about a 500, 580, because they're maxed out on every single card. Even though they pay them, they're still maxed out. And they're a huge credit risk, even though they make tons of money and have all kinds of stuff in the bank. Doesn't matter. It's the game. You gotta understand the game. Now some of them say, well, I pay off my credit card every single month. That $1,000 credit card, I put $1,000 on it, but every month I pay it off. Every month I pay it off. So really, in their mind, they have no debt because they're paying it off every month. You following me? I use my credit card, pay off the balance every month. So I really don't carry a balance because I'm paying it off. But credit is not real-time data. Credit is reported once per month. Your creditor issues your information when your statement is issued. And when your statement is issued, it's what your statement shows. And if every month on that $1,000 credit card, it shows a $1,000 balance, they don't know you're paying it off every month. All the credit bureau on the computer sees is you owe $1,000 on that card every single month. Every single month, you're maintaining a balance, and your score starts to go down. So that's where we see a lot of people that say, well, I put it on my SkyMiles card or my Capital One card because I get all kinds of points. And every month their credit limit is high, but they pay it off every month. And they think they're doing awesome, and they are. But their scores are getting killed because it shows a high balance in relationship to their limit on their credit card every single month. So we say share the wealth. If you're going to do that, put it on 3 or 4 cards and keep the balances on 3 or 4 cards below 50%. Accomplish the same thing and it doesn't ding your score. Does that make sense?
Mm-hmm. Yeah.
This is something that people just don't get when it comes to credit. Yeah.
Right, just got a quick question on the last
Yeah.
thing. So if I have, say, 2 cards,
Yep.
$1,000 limit on each of
Yep.
them, never used one of them,
Uh-huh.
I have, say, $500 on the other.
Yeah.
Does that put me at 25% usage or 50?
It does both because they look at the individual plus the cumulative.
Okay, so
Looks at both. So you're getting dinged on the individual, but okay on the cumulative. And that's why this last point is really important. A credit card that's not used is worthless from a credit standpoint. If you don't use it at least once every quarter, it kind of goes into a dormant status, and they don't give you much of a rating. So what I tell young people or people experienced, the older people that have cards that say, listen, don't have a card if you're not going to use it. Okay, if you're not going to use it, close it and just get rid of it. It's gone. But you need to try to maintain 3 to 5 cards all the time. So what I say is, take a card that month, go buy gas with it, put it back in your drawer. When the bill comes, pay it off. Next month, get the different card, go use it to go on a date, buy your groceries, put it in the drawer. When the bill comes, pay it off. Rotate through your cards so that you're using them, you're having a small balance on there, and you're paying it off. So the computer says, oh my gosh, he's got 3 cards, he uses them frequently, keeps low balances, he's paying them off every month. This guy's brilliant, right? He's gonna have an amazing score. Rather than maxing out one card and only using it all the time. Does that make sense? So you gotta make sure if you have a card, you use it. If you're just not gonna use it, close it. It's gonna ding your score in the short term, close an account. Anytime you open and close accounts, it dings your score a tiny bit, but don't worry about it. You just get rid of it. But if you only have 2, I wouldn't do that, right? If you only have 2, you probably need to get 1 more and then rotate through them. Find a card that has no annual fee, doesn't matter what the limit is, just get a small purchase, and then pay it off when the bill comes.
How big a difference does that make? It's like if you're
Huge difference.
like having 2 or 3 that you're cycling as opposed to just using 1 all the time.
It's just it's gonna take you a lot longer to get, you can do with just 1, but it may take you many more years to get an optimal score than if you have 3 or 4.
Okay, so it's a time thing
It's a
more
time
than a
thing.
maximum thing.
Well, and if you're 50 and you still only have 1 credit card and hardly have any accounts, you may not have a great credit score either, because you just haven't had a lot of accounts, which we'll talk about, which impacts your score. We'll talk about the types of accounts that you want to have on your credit.
Okay.
Okay?
Gotcha.
Any questions? You can go get, we're not encouraging anyone to go into debt here. We preach don't go into debt. If you can't handle credit cards and you just know you're going to get it and go max out at Nordstrom's, well then don't get a credit card and just deal with the ramifications of not having one, because having a max tons of debt is not worth that kind of headache. Yeah.
So I have a family member that doesn't believe in credit cards either.
Yeah.
They had one, they used it, they paid it off, and then closed it.
Yeah.
But when they went to go get a card loan, they're like, well, you have no history.
Yeah.
And so it's bad to close the credit card.
It is.
Even if you paid and you have good history?
Yeah, because you have to have an active open credit card to
Okay.
have good credit. If you had one 2 years ago, doesn't do you any good.
Well, what if they had it and used it for about a year, and then they paid it off and closed it? Does that still look bad?
Still looks bad. You have
Okay.
to have active and open accounts.
Okay.
Current open accounts to have a good score. You may not even be able to get credit if you don't have active open accounts, because again, risk, how do I know
Yeah.
whether you're going to pay something back? You don't have any history in the last little bit of doing it.
Yeah, it just came back to what Matt said, because they don't like credit, and so they used a credit card for a while, then they paid it off, and then they went to go buy a car. They're like, well, yeah, we'll put like $10,000 down. They're like, yeah, but you don't have credit. We can't give you the rest of the loan.
Right.
So
It's really hard, and I get it, because I love people that pay cash. It's
Yeah.
awesome. That's great.
we're like, I never thought I could get penalized for not having credit cards. So
Yeah. But again, 4-letter word. How do I know? I don't know you from
Yeah.
Eve, right?
Right.
How do I know you're going to pay me back? Jason first, and Chris are.
So, are you saying that if you pay it off in full or you have a balance, there's no difference there from their perspective?
Correct.
As long as your balance is below 30.
Correct.
So, and then you say they pull that on the day you're.
But your creditor, by law, has to report to at least one of the 3 credit bureaus. Those 3 credit bureaus, I skipped that part. I think I had the names up there. There's 3 credit bureaus. They have to report to at least one. They typically report the month or around the same time that your statement is issued is when they report what your balance is.
So if you pay, so let's say you back it off by 10 days and
Yeah.
pay it off so that it's 0 all the time,
That's the problem is then it looks like you never use the card.
okay, so sometimes you
So-
do want it to go.
You
balance
always
over.
want to, if you're someone that maxes your card out every month, right, and you're like, okay, I'm going to solve this problem by just paying my bill in full a week before the statement's issued, right?
Mm-hmm.
Then my statement every month comes out with a $0 balance. What does the credit bureau think? Dormant card, not using it. It's a 0 balance. Okay? So you've got to make sure you have a little bit of a balance on there and pay it off. If you're using the card to live and to get maximum points, let's say it's that $1,000 card, fine, a week before it's due, go pay $700 of it off, and then when the statement's issued, pay the remaining $300. It's just a lot to think about to do that. I mean, it's a lot you're gonna have to worry about. It's easier if you just kind of spread it out. And again, none of this matters if you're not gonna go get a mortgage loan or a car loan or something in the next 3 to 6 months. If you're gonna,
But I want to.
If you want to, then you need to do this.
It's like a game.
It's a little bit like a game. You've got to understand the rules of the
have
game to
balance,
maximize it.
At least a little balance, but no go over the 50% of your
Correct.
limit. You have to be between.
Correct. Chris, and then we'll go here.
Yeah, I'm rocked by this 3-month dormant thing. So let's say in the credit history, if I have a card for 5 years, and let's say that for the first time, like 3 months goes and it's always just been 0, not used, goes dormant. Does that cut off that 5-year credit history and it begins anew?
No,
Or if I
you still have
pay
a
that,
history.
it continues on
Yeah.
under that same.
You'll have a history, but it will take you maybe 3 or 4 or 5 months to kind of get maximum value from that history. Because it was kind of dormant for a while.
Yeah.
And now he's back in the game, now he's using it. Let's see what he does for the next few months. Okay.
And then other questions. So rather than showing 0, once the statement goes out and it's reported to a credit bureau, it's better that there's, say, $10 or $20 on there.
Yep.
Interesting. Okay. Got it.
Ideally, it's a little more than that, but yeah, you need to have a balance on there.
Okay.
I'll just a couple of things that I've found is like convenience, because it's like this can be a huge hassle. So like one thing that I do is I try to keep my utilization down. I don't know about 30%, but 50% I knew about. And most credit cards have an option where you can just say auto pay balance.
Yes.
So like you get issued your statement and then it pays the full balance.
Yes.
And so you never have to pay interest, but at the same time you get the utilization, right?
Yes.
And then also, like, I have a corporation that I function my business out of, and the only way that I have found with the way I do business to get a credit score is by taking out a credit card with my corporation. So even though I only use a few dollars here and there on that card, I just keep it active. I have an active card on my corporation, which is separate from my own personal score.
Well, that'll help. Well, it depends if you have a personal guarantee on the card. Have you looked at your credit report before to see if that card is on your credit report?
I don't see it on there.
Yeah, if it's not on, that's great. A lot of times corporate cards, they'll ask for a personal guarantee and they'll still report it on your personal credit because it's secured against your social security number. They want to be able to come after you if you don't pay it as a corporation.
Right.
So oftentimes we get that a lot. Well, this is my corporate card that's got a $50,000 balance on it. I get it, but it's on your personal credit because you have a personal guarantee and it's impacting your score. So you'd have to check to see if it's showing on there or not. We can show you how to do that. Okay, this is super important. I mean, this is the thing you'll probably take the most away. One of the things you'll take the most away of. There's just so many intricacies when it comes to that. Bottom line is, have a few cards, use them, don't maintain huge balances, pay them off when they come, try to keep the limits below 30%, and rotate through them. But you gotta have some, okay? This is particularly important if you're young. If you're young, meaning under 30, this is the easiest way to get credit, and if you don't have, this is the fastest way to get your scores up, versus if you're 45 or 50 or whatever, okay?
I had a question.
Yes.
I've heard the term multiple times of rapid rescore.
Yeah.
Like if they pay something off and someone told them, go get a secured credit card, have it for 30 days, we'll do a rapid rescore. What does that mean?
So rapid rescore means someone's score is at 620, and we really want to try to get them to 680 because the difference in rate is 0.75%, right? And their score is at 620 maybe because they're maxed out on their cards, or they just have too much debt, or who knows why. There's a collection account. I mean, not that they should pay it off, but maybe there's a judgment. Judgments you have to pay off, or they were late on child support, whatever. There's all kinds of reasons. And we have them go do that, and then we do a rapid rescore meeting. We rescore their credit rapidly, because usually that can take 30 to 90 days to get your score impacted. We can request with the credit bureaus directly a rapid rescore to hopefully see if their scores come up. But it is like, it's hit and miss. There's no rhyme or reason that it would work. You have to do things specifically in a certain order and the exact precise time where it actually can have a negative effect. So you'll hear a lot of companies out there promote, oh yeah, we do rapid rescores, we can increase your score, You got to take that with a huge grain of salt because it's not that easy, and it's not a guarantee, and it's very expensive. It may cost hundreds of dollars to do rapid rescores.
Wow.
Yeah. Good question.
Awesome.
Okay. The next 25% of your credit score has to do with the length of history and your mix of credit. And what that means is the principle of breadth and depth. So breadth and depth means we want to see that you've had lots of different accounts for a long time. The more types of accounts you've had, And the longer a history you've had those accounts, that minimizes the risk, because I know I now have a lot of history to see what you've done over the course of your life for the last 10 years. If you have a tiny breadth and depth, it's a tiny window, right? It's like looking through a peephole versus looking through binoculars. The picture is much easier to look at if I'm looking through binoculars than through a peephole. And the bigger the breadth and depth, the more information I have on you, the more comfortable I am, and the more likely you are to have a higher score, because the credit bureaus can see there's more information and data to gather from. Just makes sense.
Right.
So if you want to have lots of different accounts, mortgages, car loans, credit cards, different stuff that you've had over your life, and then you want to keep those credit cards for a long time. One thing, I'll come back to in just a minute. On your credit cards, people will often open and close credit cards all the time because they get an introductory 0% offer rate on their credit on a new card. They transfer their balance, and every year they're opening and closing new credit cards because they're getting free interest on their debt, and they think they're super smart. And it's destroying their credit score, because every time again you open and close an account, it hurts your score, but you have no depth to your score. Find 3 to 5 credit cards that you like and keep them forever. Don't close them, because we want to see lots of history with those credit cards. Okay? So the principle on breadth and depth is super important. Yeah, do you have a question?
We talked about late being 30 days.
Uh-huh.
I was in the car business for a number of years, and they would have what's called slow pay.
Uh-huh.
Is there a way they can determine that you're a few days behind or something?
No, they can't tell if you're behind, and it depends on the creditor, if they're going to report on slow pay, meaning they're going to let you make smaller payments or not the full amount over an extended period of time. You need to ask them, are you going to report this negatively on my credit report? Because I'm really not meeting my obligation if I'm doing that.
Well, I mean, you're still on time, but not 30 days late, but you're say 10 days late or 15 or something like that.
Yeah, it's only if you're 30 days late. So
Okay.
if you're 10 or 15 days late, you're just paying the late fee, but it's not being reported to the bureaus, and they have no idea that you're doing the slow pay.
I guess I could never figure out what they were talking about less than 30 days, but they seem to think they know what they were talking about.
Yeah. Yeah, as long as it's not 30 days late, the credit bureaus have no idea what you're doing. And in their minds, you're on time. Okay? Types of cards do matter, meaning if you went and got a credit card at Target, that's not a real credit card likely. Does that make sense? Or Victoria's Secret, Chris? It's not
They have
a real credit card.
fashion there,
Okay,
just
sorry.
so you know.
Yeah.
Sure.
Nordstrom used to be that as well, but now Nordstrom's is a real card. Most of the department stores now, they just look at the back of your card. If it doesn't have MasterCard, Visa, American Express in the back, it's not a real credit card. It's just a credit. It's a credit that the store is extending to you, and that does not help you. And actually, those hurt you because they're not held to the same standards as an actual credit bank, and we see mistakes all the time. RC Willey, what used to be the worst, because they just did their own credit issuance, and they were absolutely awful. And everyone in Utah had an RC Willey account, and everyone had a 30-day late on their RC Willey account, even though they didn't think they did, because RC Willey does what? Free 9-month, no interest, and somehow it always gets messed up, and was always causing issues. So if, on the credit cards, the kind of card you get does matter. It needs to be a legit card that is backed and underwritten by an actual Visa, MasterCard, Discover, whatever. Just look at the back of the card and see if it's on there. If it's not really the kind of card you want to keep. But you also don't want to go, my son did this the other day, he went to Kohl's or something, and they said, hey, guess what, at checkout, what will we do for you? We'll give you 30% off if you open a Kohl's card. Sweet! Opens a Kohl's card, right? It's not really a card, you get 30% off, but that dinged his score because he just opened a card that he has no intention of using, and in the short term, anytime you open that kind of a card, it's going to hurt your score. It's not really a credit card with Kohl's. And it's not one he wants to keep, so obviously Dad got mad and said, close that sucker right away.
But he saved $30.
He saved $30, yeah, on his T-shirts, whatever it was. So yeah, the type of credit you get does matter. Okay.
What about Macy's?
Macy's, it depends. A lot of times it's not. You need to look and see. Zion's and Macy's didn't used to be just store credit. It's just a store credit, right? And it was not a real credit card. You couldn't use it. If you can't use that card to buy a good someplace else, it's not a real credit card.
Okay.
What about Victoria's Secret?
Victoria's Secret, yeah. For
Yeah.
someone that you know.
I thought my application would be kept private.
My friend just texted me and they want to know about Victoria's Secret.
Okay, we're gonna talk just
There
quick
really
here.
is
Identity theft happens. It's an unfortunate fact of modern life. But there are certain steps you can take to help keep your personal information from falling into the wrong hands. Every day you do things to protect what's most important to you. And you know what? You do them almost automatically. Routine things like looking both ways before you cross, brushing your teeth, and buckling your seatbelt. Another routine to get into is keeping tabs on your identity and personal information. Here are 5 easy ways you can do it. Read your credit card and bank statements carefully and often. Know your payment due dates. If a bill doesn't show up when you expect it, look into it. Read the statements from your health insurance plan. Make sure the claims paid match the care you got. Shred any documents with personal and financial information. Review each of your 3 credit reports at least once a year. It's easy and it's free. And before you know it, protecting your personal information can be as routine as locking your doors at night. For more tips and tools on dealing with identity theft, visit ftc.gov/ID theft. That's ftc.gov/ID theft.
None of you have? I'm shocked. Carrie, you have?
Yeah, you know, had like my bank account be compromised or something like
Yeah.
that. Is that what you mean?
It's probably happened to me 3 times, where I got my bank statement, and if you're not looking at your bank statement, shame on you, but looking at my bank statement, and there was a $600 debit on there, or credit for something, or no, debit. I didn't know, and then I saw there was 2 or 3 other ones right before it. One was for 50, one was for 60, one was for a penny. So what's going on here? And started to call and realized that someone had somehow got my debit card number, likely from a gas station, when I paid for gas, and had stolen it, which is so easy to do, and checked to make sure it was an active card with the 1 cent one, and then they did a $25 charge to see if there was some money, bought something online, then they did a 50, then they went to 100, then they went to 600, right? This is, you know, they just kept, okay, it's working, right? And it was a pain. I had to call the bank, and all banks have fraud departments, and they could see it wasn't me because this came from Florida, you know, the person, and it took them 30 to 90 days to get the credit charges off. They refunded my money, but I had to cancel my account, cancel the card, get a new one, get a new bank account number. I mean, I did all this stuff. It's such a pain. We live in a world where people are going to steal your identity. If it hasn't happened to you, it likely will. Okay? But there are definite ways, as that video talked about, to make sure that you're monitoring your situation. You can't be 100% bulletproof, but you could try to be close. Just be careful with your stuff. It's just so easy to get if you don't have it in your wallet, if you don't have it like metal in there, you can scan your credit information. Just someone with a scanner can walk by and zip right off of your credit card. If you don't have a chip on your card, if it's not encased in some kind of a metal wallet or clip that you got, all kinds of things.
How much more secure is the actual chip?
Chip's way more secure.
Is it?
Yeah, much more. It's not impenetrable, but it's much more secure. Because the other one was just on your little, you know, the strip that was super easy to get off of. Where the chip, you have to actually have a code to get it. It has to be inserted into something to get it. It's much harder to get. Now the amazing thieves can still get it, and most of them aren't getting your information from your card. They're getting it from your information was that you paid somewhere at Walmart or with a doctor, and they're stealing that data from those kind of places. So you have no control. You heard of the data breaches that the U or Target had one, or even one of the credit bureaus had a data breach. And they lost tens of millions of people's social security numbers, account numbers, all this kind of stuff. And so it's just part of the world we live in. People all over the world, particularly in Africa and Eastern Europe, are stealing identity because it's easy money, and they can use it. And it just takes, you may not know, $5 to you is no big deal, you don't pay attention, but if I can do that to 1,000 people every day, it's a lot of money, right? So just, you want to pay attention, don't take things for granted, review your statements, try to keep things online, and just watch and protect your identity. And review it, which we'll talk about here in a minute, how you can review it. Okay, inquiries, 10%. Inquiry means when my credit's pulled by one of the 3 credit bureaus. How often do I have my credit pulled for whatever reason? 10% of my score is impacted, so how often does it get pulled? You really should look at your credit at least twice a year, I'd say every 6 months. You can get it for free once a year, which we'll show you, but you really need to be looking at your credit to make sure that you haven't been compromised and there's not an account on there that you said, time out, I don't even know what this is. Yeah.
Depending on all three of them, I heard Experian is the most critical one to have. Is that right?
No,
Does it
they're
depend?
probably the best at marketing.
Okay.
Okay, these are all for-profit organizations set up by the federal government. There's only ever going to be 3. There's not going to be more. They're independent. Their scores are all a little bit different.
Yeah.
You have 3 scores. They should be kind of within a close range, but they all are a little bit different.
You guys pull an average of all 3,
We
right?
pull all 3. With mortgages, you have to pull what's called a tri-merge. You have to pull one from all 3, and we use the middle score for qualification purposes. Throw out the high and low and use the middle. And there's no rhyme or reason for which one is the middle. Okay. Experian is just really good at marketing. They're probably the best of the 3, trying to really drive money, trying to get you to use them for monitoring your credit.
Well, do certain credit card companies or somebody use one versus the other
You have to report, if you're a creditor, you have to report to one of the 3. The big ones report to all 3. Yeah.
They're the simplest to read, to Experian.
Yeah, their online stuff's pretty easy. You know, they'll send you updates on, hey, your limit's increased or decreased. It's for free, and they'll let you know if your scores went up or down, your balances went up and down. And you pay extra if you want to actually know your score, but they'll monitor it for you. They are kind of easy. They've done a good job the last 10 years of doing that. Again, anytime you open or close an account, it's going to ding your score a little bit, not a lot. You can have, there's a 14-day window. We'll come back to this. There's a 14-day window in pulling your credit, and this changed in the last dozen years or so. It used to be that every time your credit was pulled, it dinged your score. So someone that was going to buy a car or a mortgage, they wanted to shop at 3 or 4 places. By the time they got to the 4th place, it dinged their score every single time they went there, and their score could be 50 points difference from this company to this one, just because they pulled their credit. Well, the bureaus finally got wise and said, listen, people are going to shop, and so when it comes to car loans and mortgage loans, you could have your credit pulled 1,000 times by 1,000 different companies in a 14-day window, and it's like it was pulled one time.
Okay.
So a lot of people freak out when they call us and say, well, I just got pre-qualified with USA Bank or the credit union. I don't want you to pull my credit because it's going to ding my score. It's not going to ding your score. You just did it. There's this rule. You can pull it again. It's not going to have an impact on it. Okay? That's kind of a wives' tale that's still floating out there. Hard pull versus soft pulls. A hard pull means you instigated as a consumer, yes, pull my credit. I want you to do this. I want to see if I can get credit. A soft pull, you have no control over. These companies are in business to make money. Remember that, in business to make money. And they have more data on all of us than anybody. Probably more than the federal government. Because they have everybody's information everywhere. So if I'm Victoria's Secret, and I want to try to sell the latest line to all the dudes out there that are 45 to 50, that make $50,000 or more, that haven't been late, and have a credit score of above a 650, I can call these bureaus and they will sell me that data. They will sell me your data.
Wow.
Okay? It's a cost, $5 a person, 30 cents a person, whatever it is, depending on how granular you want to get. But that's why you get stuff in the mail. That's why you get stuff in email, because they are selling your data. And they're now soliciting to you. And they're selling your data through the soft pull inquiry, meaning I'm Coca-Cola and I want to market, sell my new product, but I want to sell it, I've got this criteria, all women 18 to 35, all this kind of stuff, okay? As much as stuff as I want. And they say, great, and they go out and run a query, and when I run that query, that's called a soft pull, a soft inquiry. And that doesn't impact your score at all. That can happen 1,000 times a day and doesn't impact your score, but it happens. The only way it doesn't happen, well, it always is going to happen, but the only way they don't sell your information is you can put a block on your credit and say you can't sell my information to anybody. I may meet someone's criteria, but you can't sell it. So it limits the kind of junk mail that you get. It's kind of like a do not call list for credit. Does that make sense? But you have to request that with the 3 bureaus to put you on that list. Okay? Inquiries can affect your score between 2 and 30 points depending on, if you're getting your credit pulled every month, it hurts you, or if in a short period of time I'm getting it pulled for a mortgage, a car, a credit card, a student loan, blah, 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 right? Different types of credit. That 2-week rule only applies to mortgages and cars, not for everything. Okay? Because if someone's getting their credit pulled for everything under the sun, it poses, hey, that something's going on in their life, they need money, and it's a risk and it affects their score. I'm going fast because we're getting below on time. Okay, write this down. This is where you get your free credit report every year. By law, you are entitled to a copy of your free credit report every year, every 12 months. the 3 credit bureaus have to give you your credit report information. You go to this site and you start putting in your information, and each of the 3 bureaus will give you a separate independent report. It will not give you your score, it will just give you your information. If you want your score, it's like $7 to $12 per bureau to get it, to have them give it to you. Okay? This is the only way to get your actual score, other than coming to like a mortgage company. Credit Karma, all those companies out there that sell your score, it is not your score. They are guessing what your score is based on your data, but it's not your actual score. The only way you get your actual score is for you to get it, or for us, a mortgage institution or a financial institution, to actually pull your credit score. Okay? Those companies out there that sell it, they're not giving it. Sometimes they're close, sometimes they're not, but it's not your actual score. Sometimes people get confused about that.
Is that considered an inquiry when you do it?
No, it's not considered an inquiry when you do it.
So you can look at it any time of the year and just check it without having any.
So usually what I encourage you to do, there's 3 credit bureaus, right? You get one of them for free once a year. So go to Experian in January and do it. In May, go to Equifax. In September, go to TransUnion. So you're actually looking at your credit 3 times in the year for free throughout the year, and just you're constantly doing that, right? So every 4 months, you're looking at your credit report with a different bureau, but at least you're actively looking at it every 4 months. Okay? Free every year. And this is why all these errors, 25% contains serious errors, 79% of all credit reports contain some kind of a mistake on it, 54 have misspellings or typos, 30% show closed accounts as open, right? You closed it, but it's still showing it's outstanding or open. You just need to go here to get information as much as you can, okay? Let's show one last 1-minute video, and then if you have any questions, we'll answer them, otherwise we'll wrap up here.
Hey Chris?
Yeah?
There's some nachos or tacos in the kitchen.
Oh, you're awesome. There's some food there.
Shopping for a car? Applying for a job? Looking for a home? Or just getting your financial house in order? Then it's time to check your credit report. Good news, it's free. The law entitles you to 1 free copy of your credit report from each of the 3 nationwide credit reporting companies every 12 months. Why is it important to check your credit report? It has important information about your financial accounts, how you pay your bills, and if you file for bankruptcy. You want to make sure everything is accurate, especially before you buy a house or a car, or apply for a job. If you notice something wrong, contact the credit reporting company and business providing the information to correct the error. And checking your report can help you guard against identity theft. Visit ftc.gov/ID theft if you spot accounts that aren't yours. How do you order your free credit report? Order online from annualcreditreport.com, the only authorized website for free credit reports, or call 1-877-322-8228. You'll need to provide your name, address, social security number, and date of birth to verify your identity. Keep in mind, you're entitled to 1 free copy of your credit report every 12 months from each of the 3 nationwide credit reporting companies. So the next time someone asks, "How's your credit?" you'll have the answer. To order your free credit report, visit annualcreditreport.com or call 1-877-322-8228.
Let me write down the phone number, please.
Yeah. Oh, it went away. Let's see, how do we get it back? Did you get it or not?
No, doesn't matter, it's okay. I can go online.
Yeah, go online and they'll provide it for you. Okay, any final question? There's way more we could cover, but that was the basics as fast as we could do at lightning speed in an hour. As you can see, there's a lot of moving parts to credit. It's not as simple as it may appear. There are some basic things that are intuitive, a lot of things that are not intuitive. It definitely can impact your wallet if you don't understand how it works. It definitely impacts your client's ability to get a house. That's why we're here, is to help your clients get homes, to get them into properties. This is the thing that we spent, the very first thing we look at is their credit to see where they're at, where they're standing. Yeah.
So I had a client last year that was trying to close on it, then they pulled title and they had a tax lien on their title. And they couldn't pay it, and they were disputing it because they're like, oh, we did pay it, but there was still a lien on there, it wasn't corrected, but it delayed like the whole sale for like a month or two.
Yep.
They got it off, but the lien wasn't, they were nice enough with the letter of explanation, they removed the lien off of the title report, but they still had the lien, but they said, no, we've been paying it. So how does the tax liens work on the?
So tax liens, so on your credit report, besides your name, your social information, it shows all the addresses where you lived.
Are the tax liens on there? On the
tax liens are on there. So if you, any kind of collection, any kind of a judgment, a garnishment, if you owe child support or alimony, if you owe back taxes, tax lien, any kind of lien whatsoever, can show up on your credit report. Doesn't mean it will, but it likely will.
Okay.
Some states or counties aren't as good as reporting that on credit bureaus as others are.
Yeah.
Because they use the title as a default because they know that if it's on title, they're going to address it at some point in time if they're looking to refinance or buy because it stops everything. You have to clear those because you can't get a mortgage loan if there's a judgment or a tax lien.
Yeah, because it wasn't on their credit report.
Yeah. So if we don't see it, we have no idea. That's why getting a PR is so important, getting it right away, because there are instances where it's not on the credit, but it is on the title policy. And if we don't see it, we think everything's hunky-dory, but we can't legally close. Why can't we close if that kind of thing on title? Why couldn't we do it? What's the reason? What does it mean not clear?
It's clouded.
It's clouded. Well, let's think of it this way, okay? A title report simply lists owners and who has a lien or a holding on that property.
Yeah.
Okay? It's done chronologically. It's not done by whichever is the biggest. Meaning, you want to be in the first position because whoever in the first position is most protected. In the event the home forecloses, who's ever in the first position gets paid first.
Right.
Judgments, tax liens, and judgments always get first lien position. Period. Doesn't matter if they are new or old. They automatically, by law, get in the first position. So a mortgage will never be put in the second position because they're not going to take that risk. Your mortgage has to be in the first position to get a mortgage.
Yeah.
If I can't be in the first position, you can't get a mortgage issued. And judgments and tax liens automatically go in the first position. So unless those get cleared, a mortgage company will never close a loan because they can't be in the first mortgage lien position if they're a first mortgage. So you just have to get them resolved. Otherwise, it's a deal killer every time, right? So it's just think of it that way. That judgments, those kind of things, tax stuff, government stuff takes precedence. Okay. Any questions? Any other questions? You've been great. Hopefully this helped. You learned a lot. Feel free to come ask us any other questions about your clients or you. But happy Thanksgiving.
Yeah. Thank you.
Hey, thanks, Christopher. Thank you.
Thank you, Chris. I think we may need you to do another one. This is great information.
Yeah, we can do this often. We have a bunch of presentations.
A bigger crowd.
What do you say about this?
You want me to exit out?
Yeah, you can exit out.
Oh, happy Thanksgiving to you too. I feel like it's 5 p.m., but it's not.
No, it does. It's only